Today we're going to be looking at investments in debt securities. Debt securities, for the most part, are bonds, corporate bonds, government bonds, and how we account for those investments. Now let's take a look at the slide together here. Notice that we assume you've read this chapter and you have some level of familiarity with investments. Okay? So please review the chapter. And notice I'm not going to cover everything in there. I'm not going to cover what's called reclassification entries. Also, you may want to review the time value video that we have and review your present value calculations in particular. Okay, so assuming that you've done that, let's go ahead and let's start talking about debt securities. We have three classifications of investments in debt securities: held to maturity, trading, and available for sale. And you need to know the difference between these definitions because the accounting is different for each one. Notice, held to maturity, the investor has the ability and the intent to hold the bond or the investment until it matures. Maturity means we have to then get our money back from the issuer, of course, but we'll have been collecting interest all along. Now, trading securities. We, the investor, think we're going to sell the investment within 1 year or less. And then available for sale is kind of what I call a default classification. It's in between the two. We don't have immediate plans to sell the investment within a year, but at the same time, we're not committed to hanging on to this investment until it matures. So it's kind of in between the two, and we classify that as available for sale. Now, when we calculate the fair value of bonds, and by the way, these calculations will be the same for when you're looking at your long-term debt chapter on bond issuances. So this will help you in that chapter as well. It'll be what I call the mirror image of the journal entry. Notice when calculating the fair value, we have two different interest rates. We have the contract rate or the stated rate, and that's stated on the bonds themselves, the certificates, the bond indenture, the prospectus, the information. It's clearly stated that this bond is going to pay this amount of interest on what's called the face value of the bond. So the face value of the bond times the stated rate or contract rate gives you the interest payment that we'll receive. Now we also have a market rate, and the market rate is determined by a lot of what I'll just say macroeconomic factors, which we're not going to get into in this discussion. Okay, so GDP, unemployment rates, inflation, the price of oil, trade imbalances, all sorts of stuff that the Federal Reserve Bank takes into account when setting the discount rate from which all other rates come from. So all that aside, suffice it to say that market rates are driven by a lot of factors outside of anybody's control, and they're in constant motion. They're drifting up, maybe they're drifting down. So it is normal for both the contract rate and the market rate to be different on any given bond issuance. When the rates are different, then we're not going to invest the same amount of money as the face value. So let's take a look at these three scenarios. If for some strange reason the contract rate and the market rate are exactly the same, which is very rare, then we issue the bonds, or actually the bonds are issued at face value. So if you have a $10 million bond, the investor would pay $10 million. If the contract rate is higher than the market rate, then the market says a bond for this investment or credit risk rating, like AAA or AA, should be paying this amount. We happen to have locked in a rate that's higher. Perhaps when we initially locked in the rate, I should say when the issuer not locked in the rate, interest rates then started to drop a little bit. So then the contract rate is now higher than the market rate. And if you think about it, if the issuer is paying, let's just say 8%, and now the market rate's 7%, Well, they don't want to pay any higher interest than they absolutely have to. But it's difficult to change the interest rates so that they exactly match. It's a timing issue that's never going to work. So instead what we do is we adjust the price, or the issuer adjusts the price tag. And when the contract rate is higher than the market rate and the issuer is paying us a rate that's better than what the market says they should, they're going to charge a higher price than the face value. And we call that a premium. The bonds will be issued at a premium and the investor will have to pay more than the face value. If, on the other hand, the contract rate is less than the market rate, okay, the issuer is paying 8%, but now the market rate has gone up to 9%. Well, the investors would rather have 9%. So no one's going to invest in our bonds unless we discount the bonds. We drop the price so that the face value, okay, which is the amount that has to be repaid, okay, the investor will end up investing less money than the face value since the bonds were discounted. And what's going to happen in both the case of the premium and the discount is that the price tag on the bonds is adjusted so that they are effectively paying the market rate of interest. This is kind of a compensation mechanism for determining the price of bonds on the date of issuance when the market rate and the contract rate are different. Okay? It's much more common for bonds to be issued at a discount, so let's take a look at that example. First, we're going to look at held-to-maturity securities. We have both the intent and the ability to hold the bonds until they mature. On January 1st, 2015, ABC Company issued bonds with a face value of $5 million, a stated or contract rate of 8%, that mature in January of 19, so it's a 4-year bond, and they pay interest semi-annually or twice a year. So interest will typically be paid on, say, June 30th and December 31st. That's what we mean by semi-annual interest. Now, at the time of issuance, the market rate for bonds with a similar risk rating paid a market rate of 10%. So we're paying less than the market rate, which means we have to discount the bonds. Okay, assume that XYZ Company invested in the entire bond issuance and they plan to hold the investment until it matures. So let's see how we're going to calculate the value of these bonds on the date of issuance. Okay, as we said earlier, the bonds will have to be discounted in order to attract investors. So what the investors pay for these bonds will be less than the face value. Now here's where you need to review your time value and present value calculations. Assuming you've done that, let's take a look. First, the interest payment that the investors will receive every 6 months will be the face value, $5 million, times the contract rate of 8%. Annual interest is $400,000. Since it's a semi-annual interest payment, we divide that by 2, and every 6 months, the investor will receive $200,000 of semi-annual interest. Now, to calculate the fair value of the bonds, we discount back to their present value all future payments. So look at the little timeline here. Okay, notice we have a total of 8 interest payments of $200,000. And remember, bonds pay interest at the end of a time period. And when you pay interest at the end of a time period, then you're going to use what's called the ordinary annuity tables. So we have 2 different cash flows that we're going to have to look at. First, we have the $200,000 interest payments, and notice it's the same amount of money over equal time intervals of 6 months. That's an annuity. And since the interest is paid at the end of the period, we use the present value ordinary annuity table. Okay? Now, at the end of the 4 years, the issuer has to pay back $5 million. That's a one-time payment. That's not an annuity, so we would use the present value of 1 table to calculate the present value of that future cash flow. Now, when the interest payments are made semi-annually, you have to do 2 things. If the number of years is 4, but interest is paid twice a year, then we have 8 time periods. So n will equal 8. 8 periods. And the interest rate, which is little I, the market rate, we always discount back to present value using the market rate, not the contract rate. Okay? The market rate was 10%. We divide that in half, and we're going to use 5%. Okay? So when we're going to the tables, the present value ordinary annuity table and the present value of one table, we're going to go n equals 8 periods. That'll be the row. And then we go across until we find the 5% column. And that's what's going to help us find the factors. Okay, so I've pulled those numbers from the tables, but you would go to the tables and review those. And what we would find is that for the present value of one table, when n equals 8 and I equals 5, the factor is 0.67684. We multiply 5 million times 0.67 and we get 3,384,200. Now we have to discount back to their present value all those interest payments. So we go to the present value ordinary annuity table, and the factor, again, n equals 8, I equals 5. The factor is 6.46, and we multiply that times 200,000 and we get 1,292,642 and 642. We add those two amounts together, and the total present value of all future cash flows is 4,676,842, which is the market value of these bonds on the date of issuance. That's what the investor is willing to pay for these bonds, given that the market rate was higher than the contract rate. Let me reiterate, since this is a point of confusion. When you calculate the interest payment, it's face value times contract rate. But when we're calculating the present value of a bond, we always use the market rate. Please make sure to make that note. Here are the journal entries for the investor, and I just happened to put the journal entry for the issuer just so you can see that it's kind of the mirror image. The investor is going to record an investment at face value, 5 million. They paid 4,676,000, and so they're going to have a discount of 323,158. Now I'm going to abbreviate, but here is the investment account, and I'm just going to put 5 million, and here is the discount. Okay, and notice it's a credit balance of 323,158. So we would say that this discount account is a contra asset to the investment account. And this book value of this bond, this investment, is going to be face value minus the unamortized discount. Okay, so because we issued the bonds at a discount, our book value is 4,676,842. We record the investment at face value in the investment account, and then here's our discount account, which is a contra asset. Now, when the first interest payment is received, I'm going to receive $200,000. To determine interest revenue, we multiply the book value, 4,676,842, times half of the market rate, which is 5%, and my interest revenue is 233,842. The difference between the interest revenue and the interest payment or receipt is the amortization of the discount, which is 33,842, and that leaves an unamortized balance of 289,316. So now the unamortized discount is 289,316. That's as of July 1st, 2015. And if we took 5 million minus 289, the amortized cost would be 4,710,000. Now let's go ahead and let's take a look at the next 6-month period. On December 30th or 31st, I'm going to receive another check for 200,000. Okay, debit cash for 200,000. I'm going to amortize the discount again. And the way we do it is first we calculate interest revenue. 4,710,000 times half the market rate, that's 5%. 4,710,000 times 5% gives us interest revenue of 235,534. That's going to be a credit to interest revenue. And then the difference between the cash payment of 200,000 and the interest revenue of 235 is the amortization of the discount, which is 35,534. And that's going to give us a year-end unamortized discount of 253,782. Okay? On December 31st, end of the first year, the market value of these bonds had increased to $5,250,000, which means interest rates must have started to drop because that pushes bond values up. Since these are classified as held to maturity securities, we ignore the market value and we're going to report the bonds at their amortized cost, which is $5 million minus the unamortized discount, and you'd have to look at the amortization schedule to see what that was. And on the income statement, interest revenue for the first year will be the interest revenue for the first two 6-month periods. 233 plus 235 gives us 469,376, and that goes on the income statement. And then notice on the statement of cash flows, any difference between the cash receipts and the interest revenue will be a reconciling item to net income in the operating activities section. 4 days later, January 4th of 16, we sell the investment for $5,300,000. Notice we're going to ignore 4 days worth of amortization. We shouldn't, but we will for simplicity's sake. Look at the journal entry. Debit cash for what we sold it for, $5,300,000. When you sell an investment, we would credit the investment, right? A credit to the investment zeroes out the account. We're going to debit the discount, right? We've got a credit balance of 253,782. So I debit the discount for 253,782. That zeroes out the discount because we no longer have these bonds. We shouldn't see either account in our general ledger. And then notice we have a gain of 553,782. Not only do we know the gain's 553 just because it makes the journal entry balance, if we were to compare the cash received, $5,300,000, to the amortized cost at the end of the first year, we would see the difference was 553,782. So again, review the amortization schedule so that you're comfortable with these numbers. Okay, those are the accounting journal entries for held to maturity securities. Now we're going to look at trading securities. By definition, trading securities mean we plan on trading or selling these investments within a 1-year period, so it's going to be classified as a current asset, whereas the held to maturity is typically a non-current asset. Data is the same. Everything stayed the same. I left up the investment account, the discount, unamortized discount, and notice, same thing, market value at the end of the year is $5,250,000. The unrealized holding gain or loss, remember we haven't sold this investment yet. So we're sitting on a gain or a loss, the difference between the amortized cost and the market value. Okay, so the amortized cost at the end of the year is face minus the unamortized discount. Okay, and the fair value is now $5,250,000. We have an unrealized holding gain of $503,782. So look at the journal entry that we have to record at year end. We're going to debit an account called fair value adjustment. This is an asset account that relates to the investment. Fair value adjustment. I'm going to have to abbreviate. And I'm going to debit $503,782. Okay, and then we credit unrealized holding gain or loss dash net income, and that tells us that that unrealized holding gain or loss gets reported on the income statement. Okay? Trading securities, even though we have not yet sold the investment, any unrealized holding gains or losses go onto the income statement because of the short-term nature of this investment. Okay? So, what I suggest you do is pause, make sense of the numbers before we continue. When we sell the investment 4 days later for the $5,300,000, here's our journal entry, and we have a choice of a couple of things. Debit cash for the amount that we receive, credit the investment for $5 million, debit the discount, right, $253, credit the fair value adjustment account, $503, to get rid of these three accounts, and then notice that we have a $50,000 gain on sale because at year end, 4 days ago, the market value was $5,250,000. 4 days later, it went up to $5,300,000. We already recognized the gain from last year on last year's income statement. This year, we have an additional $50,000 gain, which will go on this year's income statement with these trading securities. Okay? Now, what we could also have done, if we wanted to, is we could have recorded the gain first, and then we would have a slightly different journal entry on the date of sale. Either way would work. We'll stick with what we have here. The last classification is available for sale. We don't plan on selling it in the short term, so it's not trading. We're not committed to hanging on for however many years this bond may be outstanding, so it's not held to maturity. It's in between. We call that available for sale. The journal entries are going to be very similar to a trading security with one notable difference, and that is the unrealized holding gain or loss does not go on the income statement. It becomes part of comprehensive income. You may need to review comprehensive income, okay, to feel comfortable with it. But notice the year-end adjustment to fair value is the same number, 503,782, but the credit goes to unrealized holding gain, other comprehensive income. Let's just briefly review. Here's the income statement, sales down to net income. Comprehensive income is below net income. It's not part of the income statement. And these unrealized holding gains and losses for available for sale securities is one of 4 primary comprehensive income adjustments. So we have the comprehensive income statement, and that's where this gain or loss will go. It's a gain in this case. And then on the balance sheet, in the stockholders' equity section, we have accumulated other comprehensive income. Okay? So there you have it. That's where this is going to end up. Not on the income statement, but since it's part of comprehensive income, it's going to end up in the stockholders' equity section of the balance sheet as part of other comprehensive income. Here's where things get a little bit unusual. So let's take a look. Again, 4 days later, 4 days into the new year, we sell for $5,300,000. So we had another $50,000 gain in that 4-day period. So I debit the fair value adjustment account. Okay, that would be $50,000. So this is what, $553,782. And I credit the unrealized holding gain, other comprehensive income, which I know the T account is not on the board here. So now, here's where you have to listen carefully. When you sell an investment, it becomes realized. When you are sitting on a gain or a loss and you haven't sold the investment, it's unrealized. When you sell it, that gain or loss becomes realized, and all realized gains or losses go on the income statement. So now, we have $553,000 in the fair value adjustment account on the balance sheet, and we have $553,000 in the unrealized holding gain other comprehensive income account, which is on the balance sheet. Okay? Since we're selling the investment and we're going to have a realized gain, we don't want to double count the increase to equity that this gain generated. Okay? So we have to reclassify the journal entry to get rid of the other comprehensive income. This is weird, I know it. So we have to get rid of the unrealized holding gain other comprehensive income, which is sitting on the balance sheet. Okay, it's a credit balance, so I'm going to have to debit that account to zero it out, and I'm going to credit the fair value adjustment account to get rid of this account as well. Then, when I record the sale of the investment, as we see below, I'm going to credit the gain on sale net income for the same amount, and that'll go on this year's income statement. Since this is the year that we sold the investment, this is the year that we realized the gain. So you may want to hit pause and review this. This is a tricky area here. Okay? So again, the unrealized holding gain is sitting in other comprehensive income, which is on the balance sheet. We have to get rid of that first. That's that reclassification entry to debit unrealized holding gain, other comprehensive income, and credit fair value adjustment for the 553. Now that that's gone, we sell the investment and we recognize the gain of 553 on the income statement, and that will ultimately end up in retained earnings. So the gain's now sitting in retained earnings, and it's not being double counted as other comprehensive income, which is the reason we got rid of the other comprehensive income in the first place. Okay, so I threw a lot at you. Review that. Try to get comfortable with it.